Hi, my name is Kanwal Sarai, and welcome to this video. What is the payout ratio? Or in other words, how to avoid this common mistake when dividend investing. In this video, you're going to learn how to avoid investing in companies that may cut their dividend, and how checking this one metric can save you from making costly mistakes. But first, we need to go over two definitions: dividends and earnings per share. When you buy shares in a company, you become part owner of that company. And as part owner of that company, you are entitled to share in the profits of that company. The dividends are basically the profits that the company is sharing with you, the shareholder. For example, if a company is paying a dividend of $1 per share and you own 1,000 shares, you will receive $1,000 every year for as long as you own those shares and as long as the company continues to pay the dividend. The dividends are deposited into your trading account as cash, so you can spend that money if you wish, or you can reinvest it. What are earnings? Basically, a company's earnings are its profits. A company generates revenue by selling a product or service, then subtract all of the costs to produce that product or service, and what's left are the earnings. Earnings typically refer to after-tax net income, also referred to as the bottom line. Most financial websites will refer to earnings per share as EPS, which are the total earnings for the year divided by the total number of outstanding shares. In this example, let's say a company has earned $812.5 million last year, and the company has 325 million shares outstanding. The earnings per share comes out to $2.50. Now that we've covered both definitions, let's move on to the payout ratio. The payout ratio is simply the dividend per share divided by the earnings per share. So in this example, a company has earnings per share of $2.50. It is paying a dividend of $1 per share. The payout ratio is 40%, which is a healthy payout ratio because, as you can see in this example, the company earned $2.50, but only paid $1 to the shareholders. What did it do with the rest of the money? Well, the company took the rest of the money and reinvested it back into the business to grow the business. So in this case, a payout ratio of 40% is pretty good, and it indicates that the company has room in the future to increase their dividend if they wanted to. On the other hand, let's take a look at company B. The company earned $2.79, but it paid a dividend of $3.21 to its shareholders. How is this company able to pay the shareholders more money than what it earned? Well, in this case, most likely the company went ahead and borrowed money from different sources to be able to pay the shareholders a dividend of $3.21. And you can see that the payout ratio is over 100%. In this case, two things will have to happen. Either the company is going to increase their earnings, or the company will have to reduce its dividend or eliminate its dividend. And as a dividend investor, that is a big red flag. We don't want to invest in companies that have a risk of cutting their dividend. So in this case, all things considered equal, company A would be a better investment. What is a good payout ratio? Generally, we look for companies that have a payout ratio of 75% or less. Now, I'm going to show you how to calculate the payout ratio for yourself for any publicly traded company. And in this example, we're going to look at Chevron and Aflac. Here on Yahoo Finance, you can see that the earnings per share for Chevron is $2.06, and the dividend is $5.16. For Aflac, we can see that the earnings per share is $3.98, and the dividend is $1.12. Now that we have the dividend information and the earnings per share for both companies, let's go ahead and calculate the payout ratio for each of them. Let's start with Chevron. You can see that I've put in the dividend information at $5.16. Earnings per share is $2.06. The payout ratio is 250%. Let's put in the numbers for Aflac, and we can see that the payout ratio is 28%. Now remember, these numbers are valid as of this recording. When you watch this video, the dividend and EPS numbers will change. Now, does this mean that you should go out and buy Aflac today? Of course not. There are other things to consider in addition to the payout ratio. Here on the screen, you'll see my 12 rules of simply investing. And what I recommend is that a company passes all of the 12 rules before you invest in any company. And you can see that the payout ratio, rule number 7, is just a part of the 12 rules of simply investing. I cover these rules in detail with real-life examples in my Simply Investing online course. Now, when it comes to dividends and dividend investing, there are a number of myths surrounding dividends. Now, I'm not going to cover these in this video, but if you're interested in learning more about them, please check out my video on YouTube. It's called The 3 Common Dividend Myths and the 3 Reasons to Own Dividend Stocks. So you'll get a lot more information there about dividends, and we cover these 3 myths in that video. Thanks for watching, and remember to subscribe to my channel for more investing videos.